So good.
All right. I know everybody's muted behind it, um, you know, um, upon entry. So it's a quiet room. It's a quiet room. Okay, so let me mute YouTube. Okay, very good. We are live streaming. We are
Going to record.
going to record. It's like checklist. All right, guys. Well, happy Tech Tuesday. Super excited you are here. I just want to say how excited I am that Jared is back on our call because I'm like infatuated with his brain. I know I just sent messages out and I'm like, I know it's not really techie, but I am obsessed with his brain and how it works and what he's doing. And, I'm like 51, gonna be 52. So retirement is like fresh on my brain as I'm traveling around in my RV trying to figure out how I'm going to do it better. So he is back on the call because you guys said you wanted to learn more about Roth IRAs. So that's why he's here, and he's going to be talking about that. So, Jared, thank you for coming. Appreciate you. Uh,
Of course.
it's all yours.
All right, very good. Well, if you guys were not here on the last call, a little bit about me. I'm Jared Davis. I'm out of Richmond, Virginia. I run a mega team out here. We have about 34 agents on our team as of today, 35. We do a little over 100 million in volume. We're on track for a little over 300 deals this year. We own a mortgage company, a closing company, a fix and flip company, and then an apartment holdings company. We've got some other investments and things like that too, but that's a little bit of a rundown. And the last time I was here, I talked about how to not pay taxes as a real estate agent. So was everybody on that call last time? Okay. Anybody doing the stuff that we talked about last time yet? Has anybody started looking into doing any of these things as far as cost seg studies and bonus depreciation? Anybody that has any updates from that last call? Okay.
Okay, so if you guys haven't seen the call, hop into Tech Tuesday, type in taxes in the search tool, and his last Tech Tuesday will be right in there. It was freaking amazing.
Yeah, and
Please watch it.
if y'all want a deep dive, I think I told you guys back then that we were setting up a long webinar on it. I spoke about it in Cabo. I spoke about it at a rally up in DC a couple weeks ago. So we actually have that webinar. It is tomorrow night at 8 p.m. Eastern. So if
Mm,
anybody wants to jump on it, I have put the link in the chat. We will go into kind of what I had talked about on this call a while back, what we'll do it live. I have 650 people registered right this second. So you are welcome to register if you want to
oh,
get
you
on.
had to upgrade your Zoom.
Yeah, yeah, we are. We are having to use a webinar Zoom. Yeah, 100%. So we have 650 registered right this second. We will, full disclosure, I will have a coaching program on helping people do this. So we're going to do about 2 hours tomorrow, but talking about what we did on that call. And it was such a hit, and it's been a hit everywhere that I really want to get the word out and tell people like, hey, if you don't want to pay taxes, this is a really, really easy strategy, and we'll explain it tomorrow night again. We will just go into deeper for the people that want help raising funds, or they want help into our deals, or they want, whatever else. If they want my hard money people and my cost seg people and all that, we're going to give them access. We're going to give them monthly coaching for people to help analyze their deals, all that good stuff. So that's what we did last time. But during that call last time, we talked about IRAs, and it came up that you could self-direct IRAs. And then people started asking all of these questions, even though they had nothing to do with what we were talking about. So I said, hey, look, I'll just come back and we can talk about self-directed IRAs at some point. So I have no slide deck. I have nothing crazy. I'm going to try to make this really, really simple, just as an overall, this is what you could be doing. And that way, hopefully, it lets you at least start wrapping your head around maybe some of the possibilities for what you could be doing. So, on the call now, give me a something in the chat, or you can raise your hand or give me a reaction. How many of you already have some kind of 401k or IRA set up? We got one,
Oh,
two,
we
three.
got we got some hands.
Yeah,
Okay.
I see a good amount of hands. Okay. All right. So it's actually probably a decent amount of all of you out of 28. Good job, to be honest. This is more than I expected. So next question. How many of you self-direct your own IRAs and 401ks? Got one, two, three. Okay. And out of the couple that are self-directing, are you just buying whatever, stocks, standard funds, whatever you want with it, S&P indexes? What are you doing with it? Is anybody actually buying real estate with their self-directeds? Linda, give it to me.
Yes, I will invest in different I took part of my 401k, moved to self-directed, and then I'll invest in people's different projects. I'm in a women's real estate group, so I have like a timeshare in San Cabo and something else in Puerto Rico. But there's other people's investments, but I put like 50,000,
Mm-hmm.
100,000. So that's what I do
Sure.
with mine.
Awesome. So Linda's already doing this. So I'm going to correlate the last two classes that we had because the first class I taught you guys was, hey, stop paying the government. Just take all of the money that you're going to have to give to the government and buy real estate with it, and then do cost seg and bonus depreciation studies. And between your cash flow and the bonus and everything else, you will literally make all of your money back every single year and you'll never pay taxes. But let's say you got some money left over and you're like, what do I do with this money to maybe alleviate some taxes? Well, you can do one of two things. You can either put it in a self-directed IRA, 401k that is pre-tax. So if you're trying to alleviate the tax burden up front, you can throw it in there. But you can also do a self-directed Roth IRA. Now, I am not claiming to be an expert on all of this. So talk to your people about the idiosyncrasies of everything. Roth IRAs, I believe the max you can put in right this second is $7,500. I think that's where it's at right now. And a Roth IRA is going to be post-tax. So it actually gets taxed on the front end when you put it in. But keep in mind, if you use my other strategy that we're talking about tomorrow, we talked about last time, you're going to be actually getting rid of your entire tax burden. So to throw into a Roth is fine because even though it's post-tax, all of those bonus studies are going to get you out of paying the taxes on it anyway. So you're going to have no taxes at all. And then you can go into the Roth because you don't have to worry about a normal IRA or 401k that's going to alleviate that tax burden because you already alleviated your tax burden. So if you're smart and you did part one, you already owe no taxes. But now you're like, okay, great. Let's throw some stuff into this IRA. So you can do this in a self-directed 401k. You can do this in a Roth. I like the idea of the Roth. And the reason I like the Roth is because when you pull the money in retirement, none of it is taxed, right? Most of you know that. If you're running a Roth, then you're not getting taxed on the income once you start pulling it in retirement. Devana, what are bonus studies? We're talking about bonus depreciation on a cost segregation study on a property that you buy, rental properties. Again, if you still have no idea, I just put the link back in the chat for our webinar tomorrow. We deep dove on that last time, and we'll deep dive on it tomorrow. I just don't want to take up people's time on this call just to make sure that we get through this piece. And then we can open for questions on everything as well. So keep in mind there are income caps on Roth IRAs. So if you make too much money, they will not let you contribute to a Roth anymore. But you can do what's called a backdoor. So you can talk to your IRA people and your financial people and your CPAs, and you can figure out a way to just move your stuff over to a Roth, even though you won't be able to contribute to it anymore necessarily. You are able to backdoor into it and get one at least open so you can get some dollars in there. Now, I think most people run into an issue because their Roths start off really small, right? They put in 7,500 bucks. So what do you do with that, right? If you told me right now I have 7,500 bucks to invest, what should I do? I'd say make more money, right? Like what are you really going to do, right? Not much. You can throw it into an index fund, S&P 500, 9% a year, and just say, great, we'll keep putting our 7,500 in. It will build and it will turn into a lot of money in retirement if you start early enough and compound. But you can also self-direct, and you can self-direct it into real estate. And one of the very cool things about this is that you can technically do what Linda is doing, where she is actually loaning to the people on other projects, which means you're essentially running a hard money loan fund within your IRA, which is very, very cool. But you can also go buy properties. So think about this. Do we have any people on the call that flip houses right this second? We got one, we got two flippers. Is that it? Three. I see three. I see a third hand coming out of the kitchen. There it is. Okay. So we got a few people. We had a few people that are flipping houses. As you know, you cannot 1031 your flips, right? You have them for less than a year, unless you're taking a year to flip a house. And then at that point, you're just probably a really bad flipper. No offense if you guys are just holding your flips for years. But I want to be in and out in like 50, 60 days tops, maybe 90 if there's a bunch of work, right? So the reality is, what do? We end up putting that into active income, and then we end up paying giant capital gains taxes. But within that self-directed Roth, you can actually flip houses, which means if you don't want to loan out on hard money, you can flip your own properties. Now, if you're one of those people that said, I only have 7,500 in here, or 15 grand in here, or 20 grand in here, right? How would I do this? I don't have enough money. You can actually pull hard money on your deals within your Roth IRA. You just have to have something invested in the deal. So you can't have nothing invested in the deal. I can't open a Roth, have $0, go flip with other people's money, make 50 grand, and then throw it back in my Roth. But what I very well could do is go take a $200,000 hard money loan, throw 20 grand in as my down payment from my Roth, go flip that house. And when it comes back with the 20 and a $50,000 profit, now my $50,000 profit takes no taxes. There's no capital gains because it's going back into my Roth. So I could have a Roth with as little as that $7,500 initial investment. And as long as I throw some of that money into that deal, I'm good to go. That means whatever that comes back to, that 7,500, if it turns into 45,000, boom, now 45,000 is in my Roth. Now what do? I go do the same thing again. Now I can throw 45,000. I take less hard money. Now that 45 comes back as 100. Now what do? I go do the same thing. But you can see that within about 3 to 4 flips, you could have enough money in your Roth where if you don't even want to contribute anymore, you don't have to. Or if you need a backdoor in because you make too much money, you could. But now you're just flipping with house money, which means now you don't even use the hard money. You're just using your Roth money. And every penny that comes back, every time you sell that house and it comes back in with the profit, it's building up. The beautiful thing about this is at some point, if you want to start buying rental real estate, you can buy rental real estate within your Roth. So rather than putting it in an S&PW fund that's going to make you 8% a year, you can put it into a property that's going to make you 8 to 10% a year, but you're going to be paying down a property. The property is going to be appreciating. Now, everything we talked about on bonus depreciation and cost segregation study on the last time, that doesn't apply here because it's already in an IRA, right? So that's why you like doing those things separately with your active income that's being taxed so you can alleviate the taxes, you can get cash flow right now. But if you combine that strategy with this self-directed Roth or self-directed 401k, what's really nice is that now you can start building a portfolio that will pay itself off in retirement, or at least start paying down in retirement. And then guess what happens in retirement? When you go to start pulling, all of the cash flow in that building is what? It's tax-free. So at that point, I don't need the depreciation because everything that's held, let's say I build a $10 million portfolio in my Roth IRA by the time I'm 60 or 70, I can now start pulling whatever that is a month, 40,000, 50,000, 60,000 a month out, right? And I'm not paying any taxes on it. If at any point I want to sell all of those properties, guess what? It's tax free, which means I could sell that entire $10 million portfolio in retirement and it comes back tax free. Or maybe I want to keep some of the cash flow moving. I don't want to pay taxes on it, but I do need a lump sum of cash. What else could I do? I can go refinance that $10 million portfolio. Maybe I want to pull 2 or 3, $4 million against it. It's still going to cash flow, right? It's still going to make me money. I'm not going to pay any taxes on the refinance regardless, and I'm still not going to pay any taxes on the cash flow that stays. That's the principle. Does that make sense to everybody? Do you have questions? Okay, you say. So give me some questions. What are some questions on the breakdown? Again, I don't claim to be a full expert on this. So if there's something I don't know, I'm going to tell you I don't know. I'm going to tell you to talk to your CPA, talk to your financial advisor, but I will answer whatever I can. Austin, you have a question? Is that
Yes.
okay?
What is your role? What do you do?
What do I do in life, like in general?
Yeah, is this what you coach people through
I'm,
this, or you're
I'm
just
I'm
Do
just
it.
a guy. If you came in the call a little bit late, I run $100 million sales team like in real estate, and then I
Okay.
have a mortgage company, a title company, a fix and flip company, apartment holdings company, and my coaching side is actually focusing on what we talked about last time. I put that link in the
Okay.
chat. See that if you see that website I put in there.
Okay.
I really am going hard into the coaching agents on not paying taxes. I think it is
Got it.
the best benefit that I can offer with my skill set. This is just another thing that I know because I run a handful of investment groups as well in my area. So I run an investment group
Okay.
called Grid in Richmond. I run one in Virginia Beach. So we're always teaching this stuff. And so I love just coming and helping agents and teaching them things that maybe
Cool.
no one else is teaching them.
I appreciate it. Sorry for making you repeat yourself. Uh, I will hit you up because I'm doing everything I was told by my CPA, and I just got audited all the way back from 2018, and they want thousands of dollars, and I've got to go talk to them. So
Ooh,
very frustrating, but I like what you're saying, and I think it's awesome because I usually do a flip a year, and it'd be awesome. I was going to start funding a Roth backdoor IRA, and
yeah.
so I like that you're solidifying. I'm thinking the right direction, and yeah,
Yeah, I mean, and to me, like again, my strategy personally is a lot different because I am doing more of the if I can invest everything right now and just do a cost seg bonus study, get out of my taxes, then I'm still not paying taxes and I'm acquiring property now, which means it's appreciating outside of an IRA, it's gaining pay down outside of the IRA, I can sell outside of the IRA and 1031, I can cash flow each month, right? So I have a little over 300 doors. I don't know if I'd mentioned that on the call, but 301 doors, about 42 million in holdings that I have some kind of ownership in. And all of that is actually outside of IRAs. That is actually in our day-to-day. And that is what I'm really heavy coaching people on because I think so many realtors are getting to the end of the year. They don't do what we're talking about today. They talk to their CPA, they set aside 30, 40,000 for taxes. If they were smart, some of them didn't set aside and they're like, crap, now I'm on a payment plan. But a lot of people will take 30%, they'll drop it in an account. And then at the end of the year, I'm like, guys, you got like $80,000 sitting in there. Like you've already saved your money to go buy a property and get out of this tax liability, but then they don't do it. And they just write a check to the government instead. And so my biggest coaching thing right now is like, hey, don't do that. Like, let me show you how to take that money, put it into property, build wealth, cut your taxes, give you wealth growth, and then start raising from other people and do the same thing. So, Crystal, question.
Yes, thank you for all this. It's definitely not something that I've forward thought a whole lot. I've just kind of been living in the moment. So, but if you're just starting out, is there a limit to like get into a backdoor IRA, I guess is what you're calling it, or is it that a Roth? I don't know. But if you want to just be your own investor and do your own flip, like is that possible, or do you suggest partnering with other investors, or what would be?
So the only reason I brought out a backdoor is due to overall income. So if you are just filing as a single person, then you can only make up to $153,000 or something around there, I believe, or 168. And if you're married and you're filing married, then it's like 242 to $252,000, right? So if you're making more than that quarter of a million a year married, then you can no longer contribute to the Roth, and that's when you need the backdoor. So essentially, what you would do is you would take a secondary like IRA that's a non-Roth that was kind of a pre-tax thing, and you would transfer some of that money over. They'll essentially let you backdoor it over. And again, I would talk to your people about that, but that is kind of the rules and regs to be able to do that. So if you don't make more than 160 or solo or 250 married, then you can just do your $7,500 contribution each year. I don't know if
I was
that
just wondering if you had like 200 grand to get started and you're like, oh, I want to go buy a property. Is it better to try to start like filtering it through the Ross, but like 7,500 doesn't seem like it'd be enough to
no, no,
go
no,
buy a
no.
flip. And so, like, if
Yeah,
you had 200 grand, what would you do with it? I guess, like, how would you start to get to?
good question. Thank you for actually giving me the number. So 200 grand, you can do a good dent with 200 grand, right? I mean that would let you go do a decent amount of stuff. So to me, if you wanted to start the Roth strategy, you could contribute your 7,500 if you're within those income ranges where you know like okay, I actually am able to contribute, then you could just contribute the 75 And then technically you could start doing what we're talking about, where, if you wanted to invest in a loan, or if you wanted to go flip and pull hard money. Now, again, I don't think you can, this is where I say talk to an expert. I don't think you could canoodle your 170, whatever, your 190 that's left with that 75. Like, I think you could only put your money in from the Roth at that point. So you would want to pull the hard money loan in addition. But if you wanted to use this strategy, you could just get the Roth funded with 7,500 and then start doing what I'm talking about. You know what I mean? You also need what's called an intermediary when you're doing self-directeds on properties. So we didn't get into that today, but ultimately you choose like the person that holds that self-directed Roth, and they're the one that actually directs the funds out and makes sure that everything is in compliance. So you would talk to somebody on that essentially on your self-directeds as well. But with the other 190,000 that you have, yeah, I mean, you can get into a flip all day at 190,000, or at least really close with a little bit of hard money. You could also get into some decent, 20, 25% down rental properties, right? I mean, 200,000 gives you the swing to be able to go at $1 million properties. I mean, you could start looking at a, 600 to $900,000 price point pretty safely if you were just trying to buy a rental. And again, that goes back to the other strategy where, if you get $1 million property with this cost segregation study, you're going to get a $300,000 write-off on year one. So the reality is, you buy $1 million property, you put 200 grand in, you're going to get a $300,000 write-off. It's going to save you 140 to 150,000 right off the bat. And then if you're making cash flow, if you're doing pay down, you're essentially going to put that whole 200 grand back in your pocket on year one, and you're going to go do it again the next year. So it's very based on how much you owe in taxes as well to try to start alleviating that. So yeah, I think you have a big chunk to be able to put a dent in with
That's
with
really helpful. So, yeah, thank you.
yeah, of course. Devana.
Yeah, you kind of answered some of my question was because I use in my self-directed IRA, I use Provident Trust as
Okay.
as the person who, I mean, the holder. Um, I diversify. I've in crypto and everything. I started with like 30, and it's up to like 100,000 because that is a legal thing I can do with my self-directed IRA. But I actually started with a larger amount into my self-directed IRA, so I must not have a Roth then because I started out with, it was 30,000.
Okay. Yeah, you,
Um,
you were probably in like a simple IRA, most likely.
well,
And
it is self-directed though.
yeah, and you can self-direct a non-Roth. The only
Um,
reason I was saying the Roth is nice is because you're not going to pay taxes in retirement. So the reality is, if you ran like a normal 401k or like a normal IRA, you can do like an IRA, and I think like your standard IRAs now, you can put like $73,000 in a year now.
mhm.
Back in the day, it was less. It was like, I think 15, 30, whatever, depending on what it is. There's different kinds.
Yeah.
But if you do that, the problem is, like, even let's say you did that as a married couple and you're like, great, we can put 150,000 in, right? Yeah, you're not going to pay taxes on that 150, but whatever you buy, it's going to compound. But when you hit retirement and you start pulling that rent, you start selling those buildings, you are going to pay taxes on everything at that point. So keep in mind, you're either a pre-tax IRA or a post-tax IRA, and the Roth is post-tax. So you've already paid your taxes on the 7,500 when you put it in. Everything else, yes, you can contribute more. And why people do that is because if they were going to pay 50,000 like income tax, right? They're like,
Uh-huh.
great, I'll just take that 50,000 in income and I'll put it into this IRA. I won't have to pay taxes on it. But the problem is, at retirement, you will. So will that 50,000 still compound better than if you had to just put it in the stock market, like paid your taxes and put it in the stock market? Of course, right? Like, if you owed taxes on 50 grand and you're
Mhm.
going to have to pay 20,000 in taxes, that means you're only putting 30 grand in the stock market now, and that's what's going to compound. With the normal IRA, you're able to take that whole 50, not pay taxes, and now that 50,000 is going to get invested. What I'm trying to teach everybody that's a real estate professional is that you could take that 50 and not put it into a pre-tax IRA and just buy real estate with it. And with bonus depreciation and cost seg studies, you're going to get out of the taxes and you're going to hold the property now. If you wanted to go into retirement, I like the Roth because everything you're going to build when you actually go to pull from it, you do not pay taxes when you pull. Whereas all those other IRAs you mentioned, your
Like
simple IRA,
after you're 65, you don't pay taxes on it, or right
Correct.
now if you pull it?
When you're 65. So
Okay.
what's going to happen is there's always going to be penalties to pull if you pull early, right? But what would happen is if you pulled early from I don't know how it works on a Roth if you pull early actually, but you would have at least the penalty, which I think is like 10%. I don't know how they hit you on the taxes and all that. But you wait till retirement, if you have $2 million in a regular IRA and $2 million in a Roth, and you were to pull them both, you are going to be at whatever that tax bracket is on that $2 million when you pull it at that time. Do we think taxes are going to go down in 20 years? They've never gone down. They only keep going up. So the reality is I don't like the idea of that. And part of it is this. Do you know why people typically want to put into a IRA that's taxed in retirement? Why? What's the reason?
So they don't have to pay taxes on that income right now.
Yes, but what's the other reason? What's their outlook on their income when they turn 63 to 65 and they
It'll be a lot lower.
Yes, because the reality is they say, oh, at 65, I'm now retired. I'm no longer working. So if I have all of these securities in the S&P 500 or whatever the heck they've been sitting in, then I'm just going to sell out what I need for the year. I'm going to take my $40,000, $50,000 to live on, and I'll pay at that tax bracket, right?
Mm.
My life is different. All of your lives should be different. You're in real estate. You should own real estate. So the reality is you shouldn't be broker at 65 than you are right now. I mean, that's everybody's outlook. It's like, how broke can I get by retirement so that my tax bracket can get? That's crazy. That's the craziest thing I've ever heard. So the reality is like all of you should be so much richer when you actually stop working, and you should have stuff that's working for you as a real estate agent. So to me, there's no way I'm not worth over $100 million in my 60s. So why would I want to go to a higher tax bracket, right? That I would be in the higher tax bracket and taxes are going to be higher. So if I pulled from a normal IRA at that point, I would just get obliterated. The Roth idea is, hey, if all the stuff is in this Roth, then at that point, everything I'm pulling is tax free. Again, I don't really care that much because I'm using these bonus depreciation studies. So to me, I'm going to keep building wealth outside of my IRAs. And when I am old, I can do the same thing. I'm never going to pay off properties. If they get paid off, I would likely just sell them all and then go buy new properties so that I can reset my cost basis and my depreciation basis so that I can keep offsetting that income. I know that's getting into more complications, but that's why we're doing the long class tomorrow. Does that answer
I
your
have another
question?
question. Yeah, I have another question. Do you have your like I have a rental property too, but I have it in a separate LLC. I don't
Mhm.
have it in my self-directed IRA, and my self-directed IRA also has an LLC. So are you what do you think about that? And also with the LLC thing, also the fact remains that can I take my self-directed IRA, what I have now, and put it into a Roth, or would I have to liquidate it and then put it in a Roth, or can I roll it into a Roth self-directed IRA?
I think that's a
Balance that I have.
Yeah, I think that's a better question for whoever's directing your
Okay.
self-directed. But
Okay.
but I'm guessing it's no because you're essentially selling the property to yourself in that aspect. You're essentially deeding it over, and really an LLC is only a single member entity typically anyway. So if you are the only owner on that LLC, like you are the LLC, you know what I mean? It's not a corporation. You are just the LLC. It's a pass-through. So because all it is a legal pass-through, I don't know if you could just take that legal pass-through and just huck it over into an IRA into
All
that
right.
LLC because
Okay.
you're essentially gifting the property from yourself to yourself. It's not really a sale. So I don't know. I would ask your director on
Okay.
how that would work. I mean,
Okay.
maybe there's a loophole, but I don't know the answer to that.
Okay. Well, this is all really good things to think about because
Now the thing is, you could keep the property, and if you have a bunch of equity, you could refinance, and then
uh,
you could refinance, pull the cash, keep the stuff in your LLC, keep the pay down going, keep the cash flow going, and then take your refi cash and try to fund, you know what I mean, one of the accounts if you could fund it over to
yeah,
the
it's
self-directed, you know what I
self-directed.
mean? So then you would just keep the property, keep it outside of the IRA, but then take the money that you get out of a refi and stuff it over into the IRA to keep investing it
Cool.
if you just needed to go liquid a little. Linda, question?
The something you said, my maybe it's different with a Roth self-directed IRA, but in a directed self-directed IRA, you can't invest in your own property. You have to loan
In
it
a
to somebody else. And so I'm a little
self-directed,
confused.
self-directed, you can still buy your own properties. You cannot loan yourself money in the sense of like if you were buying the property, you should be fine. What you cannot do is say, I'm gonna give myself a hard money loan. Right now, if you were an owner, that's one thing. You're actually buying a property. If you just said, hey, I need some money out of this account and I'm going to loan it, or even if it's family, they don't let you do it to family either. So, like,
Right.
Right.
let's say Wendy's got a brother and he's like, hey, I'd love to get 50 grand from you real quick. Can you just cut the loan? Typically, there needs to be like an order of operations away from certain stuff because they don't want funds being just taken and because again, the whole point is that it's an IRA. You're not supposed to touch it till retirement. So they want to make sure that you're not just trying to take it without paying penalties, right? But if Linda, you have a self-directed and Wendy has a self-directed, and Wendy says, hey, I need 50 grand. Linda, you can loan to Wendy out of yours, and then Wendy, you could give 50 right back out of yours to Linda, technically, and y'all get loan to each other. You just can't loan to each other. But if you're actually buying real property to flip, to my knowledge, you were fine to do that because it's not a loan, right? You're just buying the property. Does that make sense? Like you're owning real estate. Does that click?
Yeah, I'm gonna have to check into that because I thought I couldn't even buy my own for my self-directed.
That's not what I've always been taught. So
I know. I better check. I guess I was. Yeah, I'm gonna have to talk to
again,
my counsel.
I think the big thing is again the loaning of money, right? Like you wouldn't consider that a loan. Like think about it. If you bought a house right now outside of an IRA and you paid cash, is that a loan?
No.
You get what I'm saying? It's not a loan. You just bought the house. You had the cash. Now, if you needed a hard money loan on top of that, you could 100% take that hard money loan. But then that person would be what? They'd be a lien holder. They would have an attached deed of trust to that property. But you would have no deed of trust because there is no lien holder in your case. You are not the deed of trust, whatever. Maybe your hard money guy is, but you've only contributed your capital. So you can contribute your capital to a deal if it's your deal. You just can't, you're not lending money to yourself, if that makes sense.
Okay. I guess I never knew that I could
That's
buy
that's how
directly.
that's how I've
Right?
always understood it. That's always been the way I've understood is that you
Okay.
buy all the property you want. Now, again, one thing I would try to ask is, if you wanted to actually finance deals with the rest of the financing with the banks and the self-directeds, that's something that, yeah, you want to talk to your advisor that's actually doing the distributions to see what that looks like. Because to me, I think having loans would be the best thing because you still are able to leverage the bank while in that IRA. But the reality is, maybe they say they'd prefer you to buy cash once you can buy cash if you're going to hold rentals. But I think you can pull loans as well because again, if it's still an LLC, it's still you. Can you get approved? Does it pass a DSCR? Does it pass a commercial financing debt? Right? I don't see any issues with that either, technically. All right. Any other questions?
Yes. Sorry, I was typing. So for the people that don't have a Roth IRA, right? Let's say there's people here that don't have one at all. Like, how do they get one? And how do they put money in it?
So I would look up a self-directed Roth IRA trustee, essentially, because to my knowledge, you could technically just go to Morgan Stanley or E-Trade and say, I want to start an IRA. And while you can do that, right, it's probably going to play out much differently if you want to actually buy property. And, like Linda said, she's got some crypto or whoever it was, Devana, which one of you has crypto in there, right? Like you don't want to just go to a normal bank and open it because if you open an E-Trade account, you're going to be buying stocks, right? So if you want to self-direct in other stuff, then really what you want is that self-directed trustee, that person that's going to say, yes, we're going to hold this capital and we're the ones that sign off to lend it out, to buy the property, to do the things to make sure that you stay in compliance.
Okay, gotcha. Yeah, because I remember I had one when I was a broker and I ran it through payroll. I don't even know if it's Roth. I don't know what it was. All I know is my accountant made me close it because I kept pulling money out of it and getting penalized. So
Okay.
that's what happens when you're a broker.
I will say I mean, there is a guy. So, like part of our coaching series, I'm going to have the CEO of Fractional come on, which is a website now that lets you start investment groups to be able to raise investment clubs and raise money. And the last time I was on with her, she had a guy from, I think it's Horizon Trust. And essentially his whole thing was guys, if you've got all this just self-directed money that's just kind of sitting there and you need somebody to take it and employ into these investment funds and these investment clubs, reach out to me. And he was kind of like a source of that. So if anybody needs me to connect them with anybody on that front, I can probably do some digging and shoot you in the right direction, technically. So, but yeah, you don't want to just start it at a normal bank because that's not your plan to buy stocks.
Gotcha.
All right, Lauren.
Lauren.
Yeah, I was just wondering if you happen to know, can you take money that's in an annuity and move it into a Roth IRA or self-directed Roth IRA to use to buy an investment property?
I don't know the answer to that.
Okay, that's okay. I just
don't-
thought I'd ask. I'll have to
yeah.
ask the planner. Okay.
Anything wrong, and I do not know. I have no annuities, so I'm not sure.
Okay. No worries.
All right.
Also, you can hold gold and silver in a self-directed IRA. It doesn't have to be just real estate either.
Yeah.
Yeah,
Yeah.
a
Yeah.
lot of things you can do.
Yeah, the self-directed's a great idea for, people just get kind of wrapped around like, oh, I guess I just have to, own stocks in my IRA, right? Or trust fund or ETFs, you know what I mean? Funds. But like Devana said, the whole point is that this gives you freedom to invest in what you want to invest in and still take the opportunity to compound and still take the opportunity of having the tax advantages down the line, right? So
And I do it for diversity,
yeah. Yeah, all of these are just cheat codes, right? And the more cheat codes you can figure out. I mean, like I don't know if this could be self-directed. I actually think actually, hold on, I'll blow y'all's mind real quick. Let's see. I'm pretty sure. I actually
Let's
think
go.
now that I say this, I'm pretty sure. Yeah, IRAs. So there's God, I don't want this to turn into another hour, but I'm gonna throw something at you real quick. So there's a website called Prosper. And Prosper is a website that does like essentially think about it as personal loans to people that need either small business or standard loans. I think the minimum's like $1,000 and the max is like $50,000. If you go to prosper.com or whatever it is, you'll see the website pop up. Once you hit that website, you can start an account and you can actually start an account with a normal account or a IRA account. Now I started mine with a normal account. In hindsight, I probably should have just started it with a Roth and then in retirement because that's kind of what I'm going to use this for is retirement. But I'm gonna blow your mind real quick. So let me see. We're gonna do a compound interest. I know the math already, but I want to show it to you guys in real time so that I can really give you the visual. Can I share my screen? Will you
Oh, shoot. Yes.
You're good. I just sent the request. Let me know when
There
you
you
get
go.
it. All right, guys. Investor.gov, their compound interest calculator. So a normal Prosper account, if you just have it auto invest for you, it makes about 5% on average annually, which isn't bad. It's okay. It is what it is. If you were to invest in the S&P 500 index fund, you're going to average about 8 to 9% return on an annual basis. Okay. So if you threw $1,000 in for, say, your kid, right, when he was born, and you said in 50 years, we'll let you touch this money. That's not even retirement age. It's just 50 years, right? We're not going to contribute anything else monthly, and we're going to give him a 9% annual return with no variance and calculation. How much is that $1,000 worth in 50 years at 9% annual compounded interest? Throw some guesses out at me. $1,000. No more contributions. It's not crazy, but what did you say?
$1 million.
Okay.
Please. Yeah.
Any other guesses? $1,000, only $1,000, 50 years, you give it to your kid. What does it turn out to be? Anybody else want to guess?
Crazy.
You're not going to lose anything if you guess. 1.7 million. All right, so we're gonna calculate it. Yeah, so no, that was someone's guess. So look, it's 74 grand. So I say this because I say, guys, if you just put $1,000 aside for your kid in the S&P when they were born, they'd have 74 grand in retirement if you never contribute anything else, right? If you put 10 grand in, they'd have $750,000 at 50. That's 13 years before retirement, right? But now here's the flip side. Prosper doesn't compound annually. It compounds monthly because the loans get paid. And as the loans get paid, right, it spits out money monthly. So it compounds faster. That would be $88,000, right? But here's the flip side. I have an API that a client of mine built. It scrubs all of the loans out of Prosper and pulls them off of the top before anybody else can buy them. It beats all of the major hedge funds that have APIs built into Prosper as well, because Goldman Sachs and JP Morgan Chase, all of these guys try to analyze as many loans as they can. We just analyze the top loan that comes across, the newest one. And if it's a good one, we buy it. So we go for the highest interest rate payment loans with the lowest likelihood to default. I am making 18% on my money, cash on cash, compounded monthly. $1,000. Now let's break down how much compound interest matters when you're talking about buying into an S&P 500 fund, right, with your IRA versus going and doing something like we're talking about where you could make 14, 15, 16, 17, 18%. That same $1,000 in 50 years at 18% is 7.5 million.
Wow.
So let that sink in. That's $1,000 with no other contributions. That means if I had a kid right now, which I hope I never do, but if I did for some reason, I could essentially put $1,000 into this Prosper account for them, and in 50 years they will have $7.5 million.
How do you know what interest they will give him?
Because I've been running the API now for like we've had it for 3 years. So we're looking at what we've made, and we're making 17 to 18% year over year like clockwork. It's just
Okay.
and that's $1,000. So think about this. If I was like, hey, you can't touch it till you're 65 because that's when you're actually going to retire, it's $110 million. These are real
Wow.
numbers, guys. These are real numbers that the general public just doesn't ever think about doing, right? Like, this is insane. Is it like this is totally different than where we started here. But if y'all can just wrap your head around like what compound interest does, if you can actually compound at a monthly basis or an annual, right? It's next level. So I put $1,000 a month in, right? I don't have 65 years left on this earth. But again, if you did it for a kid, and even if you contributed $1,000 a month, it turns into on. Oh, that's a billion. Sorry, that's $1 billion if you were to just do $1,000 a month. So now your kid's a billionaire, right? But think about you guys, because a lot of you are sitting on this call and
Wow.
you're like, I probably don't have 65 years left, and I don't have 65 years left.
Yeah, that's right.
And the problem with compound interest is compound interest takes years to compound, right? Because if you guys don't know this, if you were to take a penny and you doubled it every single day for 30 days, how much money do you have on day 30? One penny. You start with 1 cent. What do you have in 30 days if you could compound it every day 100%? You double it. Give me another guess. One penny. We start with a cent. $600, Carol says. 600's the guess right now. Do we have a higher or a lower guess? Wendy, give me a guess. Someone
I'm
give me
thinking $60.
$60. So we have $60. We have $600. I see some whatever the range with the sixes is. What are they like? You're just multiplying to 30. Is that how y'all are getting sixes? All right. You know what the
I'll
Basic
guess
math, Jared.
1,500. 1,500.
1500. All right, so Linda, by Price is Right rules, you win at 1500, but the actual answer is 10.3 million. And if you don't believe me, you can just search it in Google because I'm not lying. You can literally search in Google. If you were to compound 100% a day, every day, and you start with one penny, how does it compound? And that's what this teaches you is that compound interest is just that. It compounds. So on day 2, guess how much you have? 2 cents. Feeling rich yet? Not very. Day 3, what do you got? 4 cents. Feeling rich yet? No. But if you can hold out for the compound, what happens is once the number gets big, if you're compounding at 1 million, then it's 2 million, then it's 4 million, then it's 8 million, then it's 16, right? That's the thing that everybody misses. So the reality is if you guys use your money right and you listen to me on the tax strategies and you don't pay any taxes, and then instead of giving the government 100 grand to go invest, you take 100 grand and invest, and you invest it in something that actually is going to compound at a 12 to 13 to 14 to 15 to 20% cash on cash return, and you keep reinvesting that money, then your compound interest is going to end up being millions and millions and millions and millions of dollars. That's why I say there's no way I'm not worth well over 100 million by retirement in case something just goes insanely wrong. because it's just simple math. I have $43 million in holdings. I personally probably have 9 or 10 million of that just in my name. If I did nothing else right this second and just stopped, it will at least be paid off in 30 years. And we would have compounded it probably 5% a year. So what does 5% a year on $10 million compound to, right? Same thing. You're at this point where there's no way you're not worth a substantial amount of money. Yet people wait until they're 40 or 50 to start investing, and then they wonder why in 10 years they don't have any money. Well, you invested into something that only made you 5 or 6%. You didn't start till you were older, and compound doesn't compound much in 10 years. You got to have a long run, or you got to have a lot of cash. So whatever you can do to save your cash and invest faster, right, will compound more over time. Sorry, I'm blowing everybody's mind now. We're way off topic. Lauren, do you still have a question?
Okay,
Still
this
up.
has whatever, nothing to do with anything, but I guess I heard your question about the penny is how much would you have at the end of the month,
Uh-huh.
but you're not gonna have 1.5 million because I'm gonna start now if that's the case.
Yeah, well, no, you're gonna have 10.3 million
Oh, even better.
at a penny, but a penny has to double every month. So it's a double every day. So
But
double
for
every
how long?
a month, just a month. It's a to double every day is 100% return every day. So it would essentially be the same thing as if you ran a compound calculator on 30 years at 100%. So think about what we're doing, right? We're plugging in a 10%, 15% return over 50 years. My math illustration is like, now imagine it's 100% return for 30 years, but we speed that up into a day, into a month. So 100% return every day for 30 days on a penny is $10 million. That's why it's so important
For
to figure
30
out
days.
30 days. I can put, you want me to share my screen
Yeah,
and
because
Google
I'm
it?
not mathematically inclined. I'm just gonna say it. So like
Let's
like I don't get it. And
see.
so you're adding interest to that
In
penny.
100% every day for 30 days. How much do I end up with? Let's see. Boom, 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 boom. 10,737,418 bucks. There you go. Do you believe me now?
So if I,
Oh.
yeah, but what's the interest on that? I mean, there has,
100%. It's 100%.
ah,
That's what I'm saying. You double it every day. So a penny goes to 2 pennies, 2 pennies goes to 4 pennies. So it's 100% a day. You're compounding 100% for 30 days. But within 30 days, 100% interest every day is a penny to 10 million. So that's why I say a lot of you guys that are invested in something, you're like, I'm making 5%. I'm like, guys, can think about what happens if you can make 10 or 12. Think about what happens if you're not paying the government and you take all that money and you invest it instead and you're making 10 to 12 compounded, right? 15% compound, right? It's substantial. It's a substantial amount of money that people are missing out on.
Wow. Leon, that's crazy.
Good morning. Hey, here's a question for you because you said this. So under the Prosper, for what you're saying, it's your interest rate. You're saying that you're doing loans in there, but those loans aren't going to run for 30, 40, 50, 60 years. So are you saying
Correct.
every month or as those loans are paying off, you're rolling into another loan that's still compounding
Monthly.
at the same average interest rate of what you were saying?
Yeah, monthly. So Prosper loans run for 3 years, typically 36-month loans. And what happens is Prosper actually doesn't make you loan the full amount. So if I had $1,000 loan that I was in for somebody, I wouldn't actually loan them $1,000. I would loan them like 17 bucks. Someone else loans another 17 bucks. So it's fractional. So what happens is if that guy defaults on his $1,000, I don't lose $1,000. I lose like 17 bucks. But what happens is every month when it pays, I get a principal payment and I get the interest. That money then steamrolls into another loan every single month. So as I put money in and as money comes back in and gets reinvested, every single month I reinvest, which means every single month we're compounding, not annual compound, monthly compound. And someone had asked for the API. I'm happy to give it to you. It's again, it's a client of mine that built it. His brother's like a genius programmer. They're both clients of mine. One runs all the payroll for Capital One in the world, and the other is a programmer for Capital One. So that's who built it. They've been running it for 3 years. They now have like close to $400,000 in their Prosper account, and it literally compounds at like 17% annually every year, like nothing. So happy to share the API. Y'all can reach out to me on Instagram if you want. It's Jared Davis RE. If you want to reach out, like I said, I don't get anything for it to refer you. I just like sharing stuff that'll make people wealthy, right? If I can share the stuff that helps get y'all there, because I find that like we spend so many years trying to make money and get into rooms to be able to like figure the game out. and then we either never make enough money to get in the room we need to get into, or we start to get in the room, but by that point we're already kind of older. And then by the time you like get the opportunity, you're like, crap, right? Like now I'm playing catch up. And so the faster that I can help people play catch up, the better, because I've built everything in the last 6 years. So I know if I can do this in 6 years and I'm worth millions and millions of dollars, that no matter how old you are on this call, we can build you something great in 5 or 10 years, right? Hold on, there's a bunch of stuff in the chat going on. Let me see. Let me see. Prosper, I can give you the API. Just reach out to me. But have been sent through verification. Weird. So you've tried to sign up, but that's odd. I signed up with no verification. Maybe use a phone because someone else just said I signed up with no
Yeah,
verification.
I signed up and it just went right through. So I'll sign
Yeah.
you up, Marcia. Just drop your email in there and I'll put you in.
Yeah, and that's tomorrow at 8 p.m. Eastern, by the way. And that's going to be mainly on the tax stuff. I really want to get you guys out of paying taxes. Okay.
That's
Any other
cool.
questions? Linda and Lauren, your hands are still up, but they were up before, so I think they're just the old hands. So I'm gonna.
No,
No,
Okay.
you
no,
have
I do
another
have a question.
Okay.
Yeah, just do you happen to have any referrals for good, reputable financial planners?
No, I hate financial planners. If I'm being honest with you, I've fired all of mine. I'll never use them. I honestly like. It's hard because the reality is like think about a financial planner, right? This is not to say don't use a financial planner. Totally get one if you want to get
I've
one.
never liked any of the ones I've had. That's
The
why.
pro the problem is this, they only make money on money they hold, right?
Okay.
So
Mhm.
think about this. If you were to say to your financial planner, hey, I could make 18% compounded monthly in a Prosper account, but you have to give me XYZ out of the accounts that you control. And oh, by the way, I think I could get out of taxes if I was able to buy all of these properties instead of staying into this, S&P fund that you're throwing me in that you're charging me 1 or 2% on each year. What do you think they're going to tell you?
No,
Yeah, because
like
they're like,
that.
well, that I don't know that. I don't know how safe that is. I don't know if you really want to take that much risk, right? Because the second
Yeah.
you give up the money, think about this. His advice to get rid of your money makes him lose money, and they're too biased. So everything that makes them money is what they want you in. So I find that financial advisors really only start working when you get to a level of wealth that what you're talking about is, oh, I'm talking to somebody that's letting me in their venture capital funds. Oh, I'm letting somebody that's in these private equity funds where they're going out and they're buying pieces of Uber and ChatGPT, OpenAI, right? Like you get into conversations in rooms like that, family offices that get in on deals where they can go buy these things that the normal people don't get access to. Great, get me in all day. Your average guy that says I'm going to set you up a retirement fund and you're going to fund it XYZ a year and this is what it's going to compound to in whatever years, like that guy never. Every single investor that I have pitched my slide decks to for my apartment buildings that has talked to their financial advisor has not invested with me. Not one. And I guarantee my returns are better than any of their financial advisor stuff. It's every
Oh,
person
I
that
agree.
it's
Yeah.
everybody that can make their own like informed decisions. Those are the people that are like, well, how do I get more money into these properties, right? We bought a building in
Mm-hmm.
June and I returned 8% to the investors in Q1. So I have $1 million into that building. I made $80,000 this quarter on that one building with
Okay.
my holdings, 8% in a 3-month period. I paid all of my investors. Most of them were getting $20,000 checks for the quarter. I had a veterinary guy that wouldn't let go of 100 grand to put in there because he's like, my financial advisor just says he doesn't. I'm like, yeah, of course he does, because he doesn't want to lose the money he's making on that money. So no, I will never recommend a financial advisor to anybody. Not to say that you can't have them, shouldn't have them. It is what it is. I can give you my tax guy, Alicia. I do not mind doing that. The one thing I do not know is obviously federal is federal. State's a little different. My guy's actually not even in my state. He's in North Carolina. I don't know where you're at. I'm in Virginia. He actually still does my state. So what I would have to find out is does he do stuff for your state? So what state are you in, Alicia?
You mean Lauren?
That's
Me?
Nevada.
Oh, there's
It was
a.
Alicia
No,
Goofy.
Alicia asked
Oh,
if
sorry. Okay.
Yeah. Nevada. No state taxes in Nevada, so that's not an issue.
Oh, well then, yeah, I can give you my guy if you want. I will say, like
Yeah.
right now, he's just freaking god awful at returning anything because we're almost at April 15th. So
Yeah.
I would not expect to
Yeah.
like have a consult
For,
call with him, but I can get you with his assistant so he can get you on the calendar. And
uh-huh.
he is very helpful. They're great when they call me back. They're amazing. They're expensive, but they're good. They're the best I've had.
Okay.
Let me see. Someone else said, "How do I learn more about Prosper Account?" Just hit me up on Instagram, and I'll put you on a group text with the guy that designed the software, and you can just get with him. And
And I just
Jared,
put
I
his
did have another
Instagram in the
question.
chat.
My hand up.
all right, go for it.
The that Prosper, two things. The Prosper thing was an example of 100%, not they don't do 100%.
No,
They're just an example
That
if
was
it was 100%.
18% on that one.
yeah, I'm pulling about 17 to 18%. The 100% is literally just a example of compound interest because people
Yeah, okay, that's what I thought.
they don't
And
understand
the other
how
question
compound.
is when you like you said, you got to start early, but for some of us, it's too late to start early because we're headed. I'm gliding to 65 this year at the end of this year, so it's kind of like what do I, I guess what you're saying is, take the money you do have and invest and just
Yeah,
don't pay taxes.
so yeah, don't pay taxes for sure. And the other thing is if you don't have much time, it's how much of a cash machine can you build while you're running so that you're investing at a high rate, right? Like in the last 6 years, I've invested over $2.2 million into apartment doors of my own cash. So the reality is I don't care how old you are, right? If you dump $2.2 million into something and you're averaging a 9 to 10% cash on cash return for that, right? That's 200,000 a year you're making in just straight interest on your money. That doesn't count pay down, it doesn't count appreciation, it doesn't count all of the other bonuses and depreciation. That's just my cash flow. Now, someone may say there's no way I can put $2.2 million into something in 5 or 6 years, and that's okay too. But it's build the cash machine, right? Because if you can go flip a house or two on the side and it makes you an extra 100 grand a year, that 100 grand every year for 5 years goes a long way when it compound when it, you know what I mean? Once it's in there. So I started at a slow burn and then I ramped up. So as I started selling my properties, I started pulling more cash back. I started reinvesting that capital, right? So I think the biggest thing people have to understand is play with these compound calculators and say like, well, how much could I actually physically invest each year and how much time do I have and what rate do I think I can get? And then it starts at least building a nice plan in your head for what you think you could have. It may not be 100 million, but if it's a million or 2 million or 3 million, it's probably better than wherever you think you would be. Austin, you have another question?
Yes. Is this something you coach people on?
Yes.
Yeah,
Like,
what we're doing tomorrow, you want a
okay.
full you want to spiel. I didn't want to spiel you guys on a call.
Yeah, I want your spiel
What?
because
I didn't want to spiel. I didn't want to do that. I really, but I was like, just come to the call tomorrow. You
He's
know what
coming to give value. If you want him
I
to
didn't want,
spiel,
yeah,
go
I
on his
didn't,
call tomorrow.
yeah, I
uh,
didn't want Wendy. I didn't want Wendy to think like I didn't want her to bring me here
yeah,
and her like he's just selling his coat.
no,
I never want people to feel that way. So like to me, like I just want to give so much value. And the reality is what we will coach on will be a year's worth of monthly calls along with a 6 week course where we teach all of the tax depreciation. I will show you my deals. I will give you access to my deals if you want to invest in them. I will give you my personal number, which I already gave you my Instagram. If you have personal direct access to me, I'll give you my cost seg people. I'll give you my analysts for my deals. I'll give you my hard money lenders. I'll give you my CPAs. You can have all of that stuff. And then we will, and I'm throwing you into my weekly coaching call for free too. So that's 52 weekly coaching calls, a 6 week course, 12 hours of training on just never paying taxes again, and then a monthly hour-long Zoom for anybody just within the group that wants to come and talk and say, hey, I'm looking at this deal. Hey, I'm wondering about how we do this. But we're really focusing on how do we acquire the real estate? How do we raise the capital? How do we not pay taxes? How to give, like, you can go raise capital. We talked about this last time. You could raise all the capital, not even put in capital. So for some of you people that are worried about your age and your cash flow, if you get really good at finding deals and finding investors, you could go raise $1 million, take sweat equity on the deal, so you still have some ownership, buy the property, and in the operating agreement, you can say that you get all of the bonus depreciation and they don't get any. Because if you invest from somebody that's a pharmacist, he can't have bonus depreciation. He is not a real estate professional. It does him no good. So you could go buy a $2 million property, have a $600,000 write-off, whatever that equates to, and not even share it, which means you can put no money in a deal, buy $1-2 million property with other people's money, and then write off $600,000 in income. That's what I'm teaching, right? So that's
Okay.
what our
So
focus is.
sign up for his call tomorrow. We got a
Yeah, yeah. No, I
Jared, thank you.
of course. I did not want to, like I
You're
said, I don't want this to be a pitch.
I
don't
know, but
anybody's
I think
welcome.
what you're doing is going to help so many people. So appreciate you. Thank you. And I'll see you tomorrow night.
Of course. Thank you guys.
All right. Bye, guys. Thanks for coming. See you next week. Or I'll
so
see you in the
much.
VIP room like right now.